Hello, and welcome to DAS Trader's Intro to Options. This is a level 4 class. That's level 4 options trading as required by various broker-dealers to get approval. This level 4 class covers uncovered or naked writing. Of course, this would not be a financial seminar without the standard disclaimer. Trading and investing can result in large losses and is an activity that's not suitable to everyone. All of the examples shown are for educational purposes. Obviously, you're trying to do the prudent thing by getting a good education before you start trading options just by being here. Hopefully, you find this course helpful. Let's dive right in. So, I've been in the financial industry for over 22 years. I started off in 1998, 1999 at the start of the internet tech bubble and really the start of electronic trading. And I've done pretty much every role in the trading industry. I started off on an equities trading desk, mainly as a market maker and desk trader. I then went on to learn options as I worked with a major educational company. I went on to found my own educational company. And currently, I am a main educator with DAS Trader, also doing institutional sales. I'm available for coaching and mentoring. Certainly check out the Learning Day Trading website to find out more information by clicking on the DAS Mentor button on the bottom of that page. Let's jump right in and talk about the various classes that we've done already and, of course, where we are now. So number one, we have Intro to Options with DAS Level 1. Okay, what we talked about in that class is covered call writing and long protective puts. We usually call covered call writing the buy right strategy because you buy the stock and then you write the covered calls against your stock position. Protective puts is like buying insurance for your long stock positions. It's a great way to make money on the downside if you'd like to keep your underlying position. You're kind of just cashing in on your insurance policy if it goes down. If you cash it in effectively at the right point, you can do exceedingly well with that. Obviously, if it doesn't go down, you just lose the money that you paid for your insurance. In the level 2 class, we talked about buying calls and buying puts. And certainly that's a great strategy if you're speculating and you want to have limited risk. And pretty much level 1 is open to everybody. Level 1 options trading is available to anybody in their IRA, any qualified plans, etc. Level 2 is available to most people as well with a very beginning level of options knowledge. I just caution that as a speculator, you know that you're taking risk. Everything that you put into the particular play is at risk. And, you know, obviously things can turn against you very fast, and you have the added risk in options of having time as a factor as well as volatility. We went into credit and debit spreads in the level 3 class where we talked about spreads and straddles and strangles. These are kind of more advanced option strategies. All of the strategies that I've laid out here really coming up and culminating in this level 4 class. Specifically, level 3 and level 4 are pretty advanced option strategies. But trust me, options gets far more advanced than even this. We can take options going into synthetic positions, strategies like iron condors and butterflies. Options trading can get pretty complex. But this is a great entry-level overview and a great introduction to options overall. But let's just round off some of our knowledge and review some things that we've already touched upon, and continue to go over some options terms. So here is open interest. Open interest is the number of contracts open at a particular strike price, both long and short. That's called your open interest. Volume is the total number of contracts traded on a particular strike price. Assignment is the process by which the sellers of options are forced to meet the obligation. Options are auto-assigned if they are in the money by more than 75 cents. This actually varies depending on the price of the stock. It could be as little as 1 cent or as much as 75 cents. Certainly, if the option is in the money, expect auto assignment. Brokers have some, different rules on this, but for the most part, just expect auto assignment if you're in the money. The buyer of an option uses the phrase "sell to close" when exiting their long position if it has been previously entered. The seller of the option uses the phrase "buy to close" when exiting a short position if it has been previously entered. So I just want you to get a good grasp of some of the terms. All right, so let's continue right along. Hold on a second. Okay, let's go through sellers of call options. The seller writer of a call has the obligation to sell 100 shares of the contract, of the underlying 100 shares of the underlying at the strike price on or before expiry. A bearish or neutral strategy. Okay, so selling call options. Let's just go over the concept of selling calls. Consider this as a naked call. Okay, a naked is not covered by any stock position. The seller or writer has the obligation to sell 100 shares of the underlying at the strike price on or before the entry. Bearish to neutral strategy, so you expect the market to go down or sideways. If it doesn't go up, you're in good shape. Short calls, short call is covered only when the writer owns the underlying stock. Now, there is a way to own the underlying but not own the underlying stock, right? So if you have a long call, that's called a synthetic position. So let's say I was to buy right now it's in November, and I'm buying a December long call, and then I'm writing a call against it. I created a covered call by covering it with another options contract. So that would be a covered call, but it's covered by a synthetic long options position, not a stock position. Next, if we own the stock, then it's a covered position. If we don't own the stock, the margin requirement goes way up. Why? Because the maximum loss is technically unlimited. So you have to have the money to cover and account for that risk. The maximum gain is the premium received. So you're really risking a lot to make very little. But of course, the reason that might be worthwhile to some people is that it very often expires worthless, except in a bull market. Compare the maximum gain and loss to the short seller of equity, okay? It's a great way to reduce the cost basis on a long-term holding by generating holdings and generate a buy stock at a cheaper in a sideways market. Personally, I think that this is a very high-risk strategy with very little, if you're doing it on a naked basis, it has a tremendous amount of risk for a small profit. It's actually the almost antithesis of good trading, where you could risk a lot and gain very little, although you will make frequent gains because a lot of times things will just chop around sideways. So the option, this option strategy has a very, very high margin requirement, and it really depends on which broker you use and what their options, department, finds necessary to allow this strategy. All right, so selling put options is a little bit different, right? So selling a naked put also has a high margin requirement, but not nearly as high as selling naked calls. So the seller or the writer of the put has the obligation to buy 100 shares for one contract of the underlying strike price on or before the expiry. This is a bullish or neutral strategy. It's usually would be done on stocks you really want to own. And if the stock price plunges, you're buying the stock that you already like at a deep discount. So in a bullish market, selling naked puts is actually a good way to get into stocks at a discount. Now, you must cash back the selling of naked puts, meaning you must have the cash to buy the underlying stock in the event that it does come down and you do get exercise and you do need to buy the actual shares. The maximum gain is the premium received. The maximum loss is the strike price less the premium received. Now, obviously, if the stock is very expensive and it plunges down far, that could be pretty significant. Compare the maximum loss to a short seller of equity. Synthetic equivalent to a covered call, okay? Why do most brokers say it's too risky? Okay, it's because you could lose everything from whatever price you write the option at all the way down to zero. this is a very cheap way to you to get into a discounted stock position in a stock you like. Now, key criteria, I think, for anyone to consider is, do you really like and want to own the stock? If you're going to invest in the stock, it's a good, cheap way for you to get into it. It's you getting into it at a discount. Each time you sell the naked put, but without actually taking and getting exercise on the position, you are basically getting a discount. So that discount could be going on for 1, 2, 3 weeks. In an up market, the stock could keep trending up, trending up, trending up, and you could keep writing that naked put and collecting that premium for nothing until finally the stock plunges and then you get filled. In which case you have to be prepared to hold that stock because it could continue to go down. And that's where the risk comes in, is that you really need to believe in the stock, believe in the company, and have some kind of longer term reasons why you're investing in that stock if you're going to be writing naked puts to enter the position. All right, so let's just go over some of the matrix of the options matrix. So the buyer is bullish, okay? Pay the premium for the right to buy a stock, right? Buy to open a long options position. Maximum gain is unlimited. The maximum loss is whatever you pay for the premium. So you have a small loss for a potentially large gain. That's just buying regular options. Okay, selling, okay, options, selling calls is bearish to neutral. You receive the premium paid, obligation to sell the stock, sell to open, gain premium received. The maximum risk is unlimited unless covered. So I prefer buying calls and doing covered calls, right, which is the buy right. I don't believe that most people, unless they have a very sophisticated strategy and some really great technology, should even consider writing naked calls. Naked calls are, tremendously risky, and they have a tremendously high margin requirement. And anybody should take extreme caution if they're going to be embarking in that strategy. Okay, buyers are bearish. So on buying puts, you pay the premium for the right to sell the stock. Buy to open long. You, the owner of the asset. Maximum gain is the strike price minus the premium paid. Okay, and then the maximum risk is the premium paid. Buying puts, okay, is the exact opposite of buying calls. Let's talk a little bit about writing naked calls and see how that goes. So we receive the premium paid. Sell to open. Maximum gain is the premium paid. Strike price minus the premium received. Now, the only different about this is that obviously there is a natural long bias to the stock market. If you really like the stock and want to invest in it and you think it's already extended and may have gone too far, writing naked puts might be a good way for you to get into a position, or maybe not get into the position and just collect money while you're waiting not to get into the position, which is great. So you're kind of getting paid to potentially take a position on a stock that you really like and that seems too extended and far away. So to me, that seems like a better bargain than the writing of naked calls. All right, so let's just go through a summary of rights and obligations to options players. It's a great summary of all 4 classes that we've just covered. Okay, long call, buy the stock. Max gain, unlimited. Max loss, premium paid. Short call, sell the stock. Max gain, premium. Max loss, unlimited unless covered by either a stock or an option. Covered by an option, it's called a synthetic position. Long put, sell the stock. Max gain, strike minus premium. Max loss, the premium paid. Short put, buy the stock. Max gain, the premium. Max loss, strike price minus the premium. Except this is a good one if you're looking to use it as an entry technique into a long, and you have to have the cash to actually buy the underlying stock if you do have to actually exercise and take possession of the stock. It's a cash-backed naked put. Okay, and that's certainly not suitable to everybody. It's for those who have a higher risk tolerance and the cash to actually buy the stock. If you're thinking the stock will go up, you can buy the stock. You can buy a call on the stock. You could sell a naked put, in which case you're going to keep the premium and never buy the stock. Take the other side of the bearish strategies, okay? If you think the stock will go down, you can short sell the stock. Buy a put on the stock. sell a naked call on the stock, which I certainly would not recommend, but it is a bearish strategy. And if you have the margin requirement and the capital and you want to take that kind of risk, that's certainly up to you. Take the other side of the bullish strategies. Now, the major difference with options is that there is a time limit as to when the stock must make its move. And that's really the big difference between buying the stock. You can kind of hold the stock as, without penalty. Obviously, you're going to pay margin or interest depending on what your capitalization situation is, but that's something that you just need to consider. All right, so let's talk about option sellers. Option sellers win 67% of the time of the stock in terms of stock direction. And I'm going to explain why we say this, right? Because there's only three things a stock can do. Possible movements of a stock is go up, go down, or go sideways. The call buyer wins if it goes up. The put seller wins if it goes up, okay? The call and put buyer lose, okay, if it goes sideways. The call and put seller wins if it goes sideways, right? So that's good for the seller. The put buyer wins, the call seller wins, right? So you have sellers winning on both up and down scenarios, and you have sellers winning while sideways. That adds up to 67%, which explains why sellers usually win. Now, that's also if you hold to expiry. It's not taking into consideration that you can trade the option away. So you can buy the option and then trade it away. All right, let's just go through the profit curve of most positions. You buy a stock long, you need it to go up, okay? You buy a long call, okay? If it goes sideways and up, you will make money, okay? Obviously, it has to go up past the break-even point, which is your strike price. A long put, it needs to go past the break-even point before you make money. Short the stock, it needs to go down. Okay, you need to be right on the direction for both long buying or short selling. Okay, same thing with the long call, okay, or the long put. You need to be correct on direction. Short the call, it goes sideways, you make money. Okay, it goes down, you make money. Short the put, it goes up, you make money. It goes sideways, you make money. Okay, you keep the premium. But now realize this is small money, right? You're only keeping the premium, which is just the fee associated with the option for the period of time. So you're playing time here, which is very, very important. All right, well, I hope that gives some clarity to you in terms of naked writing and selling calls and selling puts. If you want to learn more, DAS Trader is now offering mentoring. Go to learningdaytrading.com, scroll down to the individual trading and coaching and mentoring section, and then click on the DAS mentor button. I'd be happy to be your options mentor. Some of the things that I could work on with you is amping up your trading with options, certainly working on your trading plan, and of course, just in general, helping to teach you all about options and stock trading using the DAS Trader platform. I look forward to working with you. Have a great day. I hope you enjoyed the class. Certainly feel free to share this and stay tuned for more educational classes brought to you by DAS Trader. All the best. Thank you.